Hello, everybody. Good afternoon. Welcome to another Power Play Tuesday edition. My name is Andrea Chassin, and I'm an IRA specialist here at Quest. Super excited about today's class. We're going to be talking about navigating alternatives in your self-directed IRAs and how to grow your portfolio. We have an amazing speaker we're super excited about. Her name is Ann Winget. She's an accomplished alternative investment expert and founder of Alternative Wealth Partners, AWP, the first private equity firm founded and led by millennial and openly LGBTQ woman. With over a decade of experience, Kellyanne has raised close to $1 billion of capital for startups, oil and gas companies, manufacturing ventures, real estate, and other key emerging markets. Really interesting there. She's also the author of Pitch the Bitch, published in 2023, host of the Wealth Alpha podcast, and a sought-after keynote speaker who has shared her experience in finance, entrepreneurship, and diversity topics at events like the Women Working in Wealth and WE Global Studios Rev-Up Summits. When not working, Kellyanne enjoys traveling with her partner, trying out new restaurants, spending time with her family, and cuddling with her two big dogs. So super excited about today's. Let's bring Kellyanne up here so that she can start with her presentation. As always, if you have questions, please post them in the chat, and we'll get to them right at the end after Kelly's done. So without further ado, hi, Kelly. How
Hi.
you doing today?
Good. How are you?
Great. Thank you for being here. Go ahead and take it away, please.
All right. Thank you so much. We're going to navigate alternatives in your self-directed IRAs. I've spent over a decade working exclusively in the private sector in alternative investments. It's one of my favorite things to talk about. I also actively manage alternative funds. So it is my 24/7 business of just being in alts. So if you're familiar with anything in the private space, you know your disclosures. This is not tax or investment advice. Please, talk to your financial professionals or people in your decision-making team on how this affects your personal financial situation. We are going to be talking about some of the investments that I've done in the past or I'm currently working on. Some of the returns are projected as we have an experience in exit, but we'll make note of that in this presentation. A little bit more about my background. My name is Ann Winget. I'm the founder of Alternative Wealth Partners. This is a Dallas-based private equity company. We are a investment advisor to funds. We're actually in the middle of our exempt reporting advisory registration with the SEC. So what that means is that we don't advise individual investors about things with their financials. We actually advise the funds themselves by creating private equity investment vehicles. I've raised close to $1 billion in private capital over my career, and that's $100,000 at a time. So if there's any business owners in the audience, understand just how difficult that is. I've worked with startups, oil and gas companies, manufacturing, real estate, and other types of kind of emerging markets. I'm currently invested in everything from oil and gas working interest to fintech companies. I wrote a book last year. It's launched this year. It's called Pitch the Bitch, Grab Your Financial Future by the Bags. And it's really about understanding the mindset behind making financial decisions for yourself, not what you should be investing in, but the confidence you need to start making financial decisions with or without your advisor, because they can only do so much. And you need to really understand how powerful your money is and having confidence in making those decisions. I also host a podcast called The Wealth Alpha. It breaks down seemingly complicated financial concepts into little 15-minute, easy to digest podcast episodes. So let's jump right into it. Most of you probably are familiar, if you're looking around at self-directed IRAs, that you have to be invested in the alternative space. It really is a vehicle that is powerful when it comes to making these investments in this industry. Now, the definition of alternative investments is anything that's outside of stocks, bonds, and cash. This can be real estate, private equity, hedge funds, commodities, collectibles, essentially anything that isn't publicly traded. And you can have also in the public market too. But for the most part, this is going to be a tangible thing that you make a decision on outside of your typical financial advisor. Some of the things about alternatives is that there's less liquidity. Typically, most of the alternatives are illiquid unless we're talking about like a precious metals or maybe a real estate, which has a pretty open secondary market, meaning that once you purchase that thing, it is easy to sell into the open market. Things like hedge funds, private equity, promissory notes, things like that are actually very illiquid. It's hard to find a secondary buyer for that. It takes a lot of time and effort if you're doing it on your own, or if you're in through a managed fund, that also takes a lot of effort to try to sell that to another party once it's been sold once. Um, they those deals can be very complex. Most of these assets are run through asset managers or fund managers. These are people that are professionals in each one of those asset classes that can manage that asset on behalf of investors. With self-directed IRAs, you can actually go directly into these assets and manage them yourself. Or you can go in through a managed fund. And you'll see that a lot with real estate syndication. Most private equity and hedge fund opportunities are too large for an individual investor to make an investment into. Those minimums start at $2 to $10 million, which is really large in the institutional space. There are managers out there in the venture capital and PE world, myself included, that allow access for individual investors to make $100,000 or $500,000 investment into those $100 million deals that are institutional grade assets. The one thing about alternative investments is that it adds a lot of diversification to your portfolio. It used to be that you would have a significant amount of your portfolio invested in the public stock market. But if anything has been proven in the last 3 years, or if you were around and investing in 2007, 2008, there's a lot of volatility there. And if you lose a lot of that value overnight or in a very short period of time, you have to be reinvested in that space for another 10 to 15 years. And that's what you saw in 2008 when people's net worth dropped in half. It took them until now to gain that back. And now we have another 30-40% drop. So people who might have been in the middle of their career in 2008 are in retirement now. They just don't have the time to sit and wait another 15 years to regain the loss of their net worth. So alternatives add a lot of diversification in order to hedge against that kind of volatility in the markets. With alternative investments, there are more risk, but there's also a potential for higher return. Alternative investments also give a lot of incentive in the tax space. And also, if you want to get creative with deal structure, an opportunity that can really fit into somebody's personal portfolio and their financial situation. I get really creative in this space, especially with self-directed IRAs when it comes to private equity, because typically your IRA money is more patient than cash or something else that you have invested somewhere. And so you can get creative, one, on the tax planning side, but two, how long you're invested in these assets. Because again, it is really illiquid. You should be expecting to invest somewhere between 5 and 10 years in this space. And that's across most alternatives. Real estate, I think, is probably the most liquid type investment in the alternative world, besides like precious metals or a collectibles, wine, art, things like that. Which is good, but your returns are going to match that liquidity. So if you have buyers lined up in an industry or an asset class, your return potential in real estate sits between realistically 8 and maybe 12% on a good day. When in private equity, because of that illiquidity, because you're in the asset for longer, you can see essentially higher 20, 30, 40% IRRs or more in the venture capital space. So my specialty is private equity. It kind of encompasses everything. It's kind of a mysterious asset class. This is where the institutional and family office world invests very heavily. If you look at some of the largest endowment and pension funds in the world, you'll see that a majority of their portfolio is in private equity. It's not in stocks. It's not in bonds. They're doing private alternative deals. And this has been a huge shift over the last 40 years. And it's a kind of an industry kept secret, and they really try to gatekeep it from individual investors. Even though if you have $1 million net worth, you can be pretty active in this space. In private equity, there's kind of three lanes, and this is the type of capital that's being invested. There's venture capital, growth equity, and buyout private equity. Typically, there's a leverage piece of that, but venture is going to be your early stage startup. It's going to be their highest risk capital in private equity. This is what most people are very familiar with when it comes to private equity. They typically think, oh, venture capital. This is an extremely competitive space. It is also a very niche type of investment vehicle. Most venture capital funds have a very strict mandate as far as what kind of investments they can make. So the investors that are on their cap tables are very aligned with those missions. And there's a lot of options out there as far as if you're going to start investing in the venture capital world, you can probably find a fund manager who matches your mission and intent with what kind of investment you'd like to make. Now, the space that I exist in is the growth and buyout world, and that's more established companies that are maybe struggling and teeter-tottering on this profitable, not profitable fence. They've maybe exhausted their bank relationship. They can't borrow anymore, or they can't borrow enough, but they're like right on the cusp of scaling in a major way. We get to come in as a capital partner and an advisor to help those companies scale. And on occasion, we do buy out. This means that we come in and we literally buy a company. We change the operating team. Sometimes we keep those families involved or the original business owner. For the most part, we're putting a more experienced team. We're putting a lot of capital behind it, and we're taking that business and scaling it on our own. So I just want to give you kind of some examples of things that we've done in a managed private equity fund, and you can technically do these deals on your own and in a self-directed IRA. A lot of our clients and investors that are moving money in their self-directed IRAs have made these types of investments directly. We've also been able to get really creative with Roth conversions and some other interesting things, and I'll talk about that here in a minute. But here are kind of 3 examples of things that we've done just in the last year. We've invested directly into a coffee farm in Jamaica. We actually mortgaged the 1,000 acres that are inside of the Jamaican Blue Mountains. We charged a 15% interest on that mortgage note, and also bought 1.1 million shares in that company. So we're actively selling this property. It should sell for about $25 million. Of that $25 million, we will have our $3 million return plus interest, and then an additional distribution of profit on the remaining $21 million on that 1.1 million shares. So that's kind of a really unique deal. The reason why we structured it that way was because I didn't want to invest $3 million into directly into a startup company that was building out this coffee operation. Instead, I wanted to have a little bit more security on our investment. So that's why we decided to mortgage the property instead of invest directly into the company. It just protected our capital a little longer because we have a tangible piece of property attached to that investment. And because we're the only investor in that project, we're able to get creative that way. In oil and gas. Now, I'm 5 generations in oil and gas. It's just what I love to do. And, I've worked with hundreds of oil and gas companies over the last, 10, 12 years, and all different types of projects, from either really, really big, 2-mile laterals to short, shallow vertical wells with owner operated, family run operating companies, to big publicly traded ExxonMobil, EOG, and privately owned like Devon Energies. So I've worked on them all, and it's just a space that I feel really comfortable in. So we've done about a $2 million investment. This is just one of our oil and gas investments out in the Permian. The total project was over $100 million. We partnered with a family office that wrote the other. In total, we had $15 million invested. So they wrote the other $85 million check. We came in with 15. We borrowed a big piece of that. But between the time that we signed our contract on the project and funded, the revenue off of the wells had paid down our purchase price, $7.5 million. So we ended up only having to borrow about $4 million of the $3 million of equity that we brought to the table. It was a really, really unique deal. In the past year, it's already delivered a 10% return as far as cash flow goes. We've been able to use the additional cash flow on that property to pay down essentially 100% of our debt. which is really great for us because at $85 oil, that property is worth $36 million. And our total out-of-pocket cost on that entire thing was $3.5 million. So really big win there, which you can do when you're getting creative, especially when you're only dealing with one other person on a deal like a family office. This is the benefit of working with an active manager in a space that you're interested in investing in, instead of trying to do these projects on your own. If you are interested in oil and gas and you want to invest directly, there are people that you can partner directly with in the industry. Just make sure that you're doing your due diligence, because oil and gas is one of those spaces that has a lot of bad actors. And they're really easy to find. So, you can start with a simple Google search and find a majority of out about them very quickly. Um, the third and final deal we'll talk about is a manufacturing deal. We have about $3 million invested. This is kind of the exciting part of private equity, is that it's sloppy. And so when things get messy, you get access to a lot of opportunities. So we were invested as a lender in this originally, and through a series of bad decisions and bad events, there was a buyer that came in at the end of the year that kind of took over the business, kicked the family out. And essentially bankrupt the company in less than 6 months, and then handed it back to the family for pennies on the dollar. We were able to come in, finance that deal, and take over the company. We now have access to about $12 million worth of assets that were sitting on the books, and we're bringing in an institutional partner to fund out the rest of how this should have grown, by putting in appropriate management with people with the right experience. And with an institutional partner backing that, we're able to come in with very little capital and have a really powerful check writer behind us that can build out a company that'll essentially do about $100 to $150 million in free cash flow within 18 months. So you would get access to really cool deals in the private equity space. And as long as you're open and open-minded and willing to be creative as far as how you structure your investment, you have the ability to do that in your self-directed IRA. Um, one of the examples I want to talk about as far as using your self-directed IRA inside of the alternative space is, I've had a client that wanted to invest in some more private equity. They had a traditional IRA set up that was already invested in a fintech company. When I spoke to this client, we were talking about the different ways that they can invest. They had a Roth, they had a traditional, and they had some other accounts too. But through these conversations, we realized that we could do a Roth conversion on the traditional IRA that he had already funded a fintech investment with, get a valuation of $400,000, which was his original investment into this fintech company, pay the taxes on that $400,000 convert into a Roth IRA. And that Roth IRA now holds that fintech investment, which in 2 years has a planned exit of which will net him about $10 million on that Roth IRA. That $10 million is now tax-free, essentially saving him a $2 million tax bill if he were to take that still in his traditional IRA. So you can get really creative with moving money from your traditional IRA to a Roth IRA, or moving money out of an old 401k into a self-directed IRA. There are opportunities for you to be in a tax-deferred or a tax-free investment vehicle and put it into assets that have the potential to really exponentially grow your retirement, more than any type of fixed income or stock portfolio that your advisor might have you in. These are the type of ways that you can get invested with your self-directed IRA or cash. It just depends on what you're using to invest. Self-directed IRAs are great because of those tax incentives. You can invest directly into managed funds. You can directly invest into promissory notes, either promissory notes that you've written between you and another individual, or other people's promissory notes. You can invest in funds of funds, so people that run funds that invest in other funds. The downside to that is that obviously you're paying kind of fees on fees. Managed funds do have fees, but that's kind of like you have to exchange one for the other. Your IRA sitting at your current advisor is being charged a fee for all the money they manage over there. You move it into a self-directed, you have obviously your paper fees at your custodian, but typically in these investments that you're making, you'll pay fees on there too. Sometimes they're less than where you are now, sometimes they're not. Or you can make a direct investment. You can own gold, you can own property, you can own oil and gas interest, you can own direct interest in really anything that you could possibly imagine. I love the alt space, and I think that I'm leaving a lot of time for Q&A because, these deals get really kind of crazy, and I want people to have the opportunity to ask a lot of questions. There's not a lot of opportunity for you to sit and talk to an active fund manager in this space. We currently manage over $25 million in assets. We have, several different types of opportunities, and work with large family offices with several $billion under management. So if you have questions about the types of deals that you can get involved with, or you're thinking about, different types of asset classes, I'm here to answer questions about them because we're invested in these things all day long and across all different types of industries. Here's a slide. It has my link tree, which you can find out, more about me, the different things that I'm doing, where I've been in the press. It also has a link to where you can purchase my book, and also the podcast. And I'll open it back up to you guys.
Excellent. Thank you very much, Kellyanne. That was really, really interesting. Let me go ahead and pull you down for a little bit. I want to give people enough time to put their questions in the chat. And in the meantime, what we'll do is we'll go over some slides here of my own that I want to share with everybody. First, of course, our disclaimer, like we always do, Questions Company does not provide any tax, legal, investment, or structuring advice or endorse any products, services, or investments of any type. All information and material shared here today are for educational purposes only, and all parties are encouraged to consult with their attorneys, accountants, and financial advisors before entering into any type of investments. Okay. Now, if today's presentation resonated with you, if you're looking to maybe proceed and go ahead and invest with your self-directed IRA, but you're not sure what the process looks like, etc., go ahead and scan this QR code so that you can book a consultation with one of us, with an IRA specialist. We'll take you through the process. We'll explain everything to you. It's pretty simple, really. It's just 3 simple processes. But if you want to, discuss and take a look at what that looks like in terms of the processes and how it all flows, we'll be happy to talk to you. So scan this QR code and book something at your convenience with us, okay? And then I want to talk about this for a little bit. This is our QuestCon Live that we're extremely excited about, Women in Alternative Investing. I want you all who are watching right now, stop what you're doing, scan this QR code. I'm going to give you in a minute to actually scan the QR code and register right now. And I'm going to tell you why. So first and foremost, on November 17th, we're going to have a group of women leaders in our industry. Some of them who are going to be speaking on panels, coming together and talking on different topics related to alternative asset world and investing. And it's going to be amazing. These are some of them that are going to be there. Kellyanne is actually also going to be part of one of the panels. And we actually also are bringing in Mary Moore. I'm not sure if you're familiar with her, but she was part of the Congress process whenever they passed the Roth IRA. So she's an expert on that as well, and we're so excited to have her join. But that not only that, it's completely online for a full day, November 17th, which is a Friday. It's completely free to join us. And fourth, I think it's the 4th point. If you miss it, we're going to send you the recording. So it's a win-win. So that's why I'm going to give you a minute right now on the clock to go ahead and scan the QR code and register for this event. And I'm actually going to post the link on the chat too, in case you can't do the QR code. So I'll give you a minute, guys. You can tell me in the chat too once you've registered. It shouldn't take you more than a minute. I feel like I should play some music here. Awesome. Thank you for that, guys. This another event or socials that that are coming here shortly in the month of November next month. So thank you, Kenina, for that. Yeah, I figured some of you already had registered for that event, but I wanted to give the rest of you a chance to do it because again, it's just a win-win. And if you aren't even able to make it that day, you can get the recording. You won't be able to really get the recording afterwards. And it's going to be a really, really great opportunity, really great information. So this one, though, is for those of you who are in the state of Texas, either Houston, Austin, or Dallas, or close to any of these, cities. This is going to be our next huge social event. Remember, we're going to have a panel too, speaking on the rental continuum, decoding short-term, mid-term, and long-term rentals. But as always, we're going to have people raising capital there with projects. We're going to have people looking to invest, Quest clients, and we're also going to have vendors and sponsors. So it's going to be a great. I don't know if you guys attended the last one, but we had a pretty huge turnout. At least in Houston, we had over 200 people come in. So it's a really the best opportunity you'll have for networking in person. Of course, as always, we'll provide free food and drinks. So that'll be on Quest. And so I hope to see you all guys there. That's it for me right now. So I want to bring Kellyanne one more time on here, along with her contact information, so we can tackle some of these questions here that have come in. I have Raubon data. Do these investments have UBIT, UDFI? What investments do not have these? How to avoid or minimize these taxes on self-directed IRAs? I can speak on this if you like, Kellyanne. Yes. I think I actually spoke with this person yesterday, but yes, Mr. Bandata, there's we can take this offline to explain what UBIT and UDFI and how they're triggered. But basically, it's whenever your IRA invests in a business that generates UBIT or unrelated business taxable income, or whenever your IRA purchases property, whether directly or indirectly, that is debt leveraged. So those are the two instances that you'll see. There's a third one, which is when your IRA leases personal property. That's another way of triggering UBIT. And yes, how to avoid it and minimize it, we can talk about it offline. Like I said, we have a lot of education on this topic as well. But thank you for your question.
Yeah, it definitely depends on what you're invested in and
yeah,
how the income is earned from that investment.
Mm-hmm. Next, we have how do you find your deals and how do you structure the deals, specifically in real estate?
Well, I'm not going to give you my secret sauce, but it has a lot to do with the fact that I've been doing this for over a decade. But I have a wide network of just asset managers or people that are in the private equity space. And so when there's a really unique deal, people come to me with those opportunities. If you decide to go find me on the internet in the world later after this presentation, you'll see that I talk about real estate often, but it's usually, I think real estate's really boring. And because the returns, like compared to private equity, are just not there. And so unless a real estate deal is really interesting, I don't participate. People do not come to me for real estate deals. They could go out their back door and find a real estate deal, like shouting into the wind, and there'll be 50 people that show up and say, I've got a real estate deal for you. Any type of real estate that we're involved in is either owner financed or creatively financed. Or we do a ground up development, which we go in and we do interesting RFPs, and then we build out what that looks like. We partner with local developers. We do this in our Opportunity Zone Fund. We've essentially we productized a local economy. So we're not just building affordable housing or an apartment complex or a Hilton in the middle of nowhere where no one wants to go or live. We're more focused on the institutional, industrial and commercial space as far as real estate goes. An example of one of these projects is actually in East Texas and in Greenville. We bought a commercial property out there. We had an owner financed at 4.5%, and took it over. We essentially bought it for about $500,000 under market value, and kept the businesses inside there and have incubated them. So it even if there's a piece of real estate attached to that deal, it's usually a much deeper, more complex deal than just buying a building or buying land.
And also probably longer too, right? Longer term probably than your.
We're not fixing or flipping or anything like that. Like there's a lot of value sitting in real estate, and it's from both the businesses within inside that real estate and the physical piece of property. So, our goal is not to make quick money and pay a bunch of taxes. Our money is to be, smart about our investments, because we intend to hold these for long periods of time. It's an important piece of your portfolio.
Excellent. We have Kit Nina Moore. Wonderful presentation. Is there a minimum investment amount as long as you're accredited?
So most alternatives, you're going to be seeing minimums of $50,000 to $100,000. In my funds, the minimums are $100,000. In the Qualified Opportunity Zone fund I manage, the minimum is $500,000. For venture capital, though, there are emerging fund managers that take minimums of 10 or 15 or 10, 25 million or $25,000. There's also a way to do SPVs into private equity deals, and those are much smaller entry points as well. But for most private placements, you're looking at $50,000 to $100,000.
And so in these cases, are people able to maybe pool funds together through different type of different accounts and partner them up?
Yes, and so it's really up to the fund manager in most cases. For us, for example, if we accept IRA money, about half of the capital we have under management is from retirement accounts. We do open that up because some people have weird amounts in their IRAs where it's like, well, I moved this IRA and it's got 72,302 cents. So that is our new minimum. And so we're flexible with people that are using retirement accounts, because we know that most cases you can't add to that in your retirement account, so you can't bring it up to a minimum. So we just accept whatever is sitting there, less whatever you have to keep with your custodian.
Excellent. So it's more like a case-to-case scenario.
Yeah.
Awesome. We have how to find the tech deal similar to the one you mentioned.
Yeah, the tech deals are really interesting because in the VC space, it's really competitive, and it is kind of like, who do you know and can have access to, like, friends and family rounds, seed rounds of pre-IPO companies. And even really early in my career, raising capital for things like Snapchat, it's really picking up the phone or knowing somebody who has access to that industry. If you're interested in getting involved in like the private equity or venture capital space and want to get into these kinds of companies, PitchBook is a really good place to go start looking at these things. That's where you can find these emerging managers or funds that are raising for different tech startups. You're not going to typically be able to come in by yourself with any type of small amount. Most of these things are done through SPVs or managed funds. Unless you know those people like personally, then you can come in through a seed round. But there's people like me out there that allow individual investors to come in, and then we're exposed to that space.
Excellent. Thank you.
And you can check some of them out. Like we're invested in the Series B round of Ellevest, which is a financial services platform. Co-founded by Sally Krawcheck. She's from Citibank and Merrill Lynch, if you're familiar, and fangirl out about financial professionals like I do. Another one would be like Gritty and Pink, which is a marketplace for creators, as far as like musicians, producers, photographers, writers, things like that. It's an interesting space to be inside of, especially, I'm assuming, if anyone's looking around for like AI companies and things like that, we can have a conversation about it.
Mm-hmm. We have, are any of our deal are any of your deals debt leveraged, or does your group and the family offices pay cash for them?
Family offices pay cash. We do not take on any debt. At this point, with rates the way that they are, you might as well just pay yourself, or partner with investors, because it's a lot easier to pay an individual investor 9-10% than it is the bank. Mainly if you're doing stuff that doesn't have real estate attached to it. Again, if you've watched any of my interviews, you'll hear my opinion about what I think about banks.
Right. That's an excellent question, and I just wanted to add that since your deals are not debt leveraged, then it wouldn't trigger UDFI. So, great question there. Well, we have Steve saying, "Thanks, good info." And we have another question here: how long should you expect your funds to be tied up for equity deals?
It depends on where, like me specifically, 5 to 10 years. I like to be in and out of things faster than 10 years, but for the most part, if you're in venture capital, private equity, it's somewhere between 5, 7 years. You can have earlier exits if you're in later stage funds. And it really depends on how exposed they are. Like, we have a lot of diversification, so we have more liquidity than most traditional private equity. And that's because we're invested in oil and gas, we're invested in real estate. So those things kick off a lot of cash flow, and we pass that through to our investors at the front end of the fund while we wait out longer term equity exits.
Excellent. Great. We have Travel say, thanks, got it, we'll contact you.
Great.
Anybody else, any questions? Now's your time, guys, to post them in the chat. We'll give them a minute or so, and before we end here a little bit early. Oh, there's one more here. Do you have any deals that turn around in 3 years or less?
I mean, yes and no. So yes, we have deals that have exited early. And we have in the coffee farm, for example, that I spoke about in the presentation, we weren't expecting an exit until 2025, 2026. But because of the demand of we're in a commodity super cycle in general, but there's a lot of demand for coffee, and especially the most expensive coffee in the world. So, that was an interesting thing that just happened to exit in less than 24 months. So yeah, there are opportunities that are less than 3 years in the private space.
That's awesome. That's really quick. Excellent. I think that's it for now. I wanted to thank you again, Ms. Winget, for speaking to us today and to our audience. It was amazing to have you, and super excited to have you for QuestCon.
Yes, I'm excited for the panels.
Yes, and yeah, everybody who joined us, thanks again for joining us, and we'll see you again soon. And let us know if you have any questions. But that's it for now. We ended up a little bit early. That's good.
Thank you.
All right. Have a great day, everybody.
Bye.
Bye.